Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Jerome Powell points to inflation as the reason for reining in the number of cuts in 2025, sparking the worst sell-off for the S&P on Fed Day since 2000. Israel's deputy foreign minister says Syria's new leaders are trying to persuade the world they are not radical Islamists, but her government isn't convinced. Well, it's just gone 8 a.m. across the Emirates. I'm Christine Burke in Dubai in for Jumana Bersechi. Well, welcome to yet another day where markets are going to be squarely focused on central bank rate decisions. We did just hear from the BOJ. They opted to hold interest rates steady, and we will be talking about all of that over the course of the show. But first, let's talk more about the Fed because we got a pretty nasty day in markets yesterday in the wake of a more hawkish tone from Federal Reserve Chair Jerome Powell. Policymakers indicating we're heading for just 2 rate cuts in 2025 versus previous expectations for 4 rate cuts. So really that hawkish tone driving losses across markets. This is the market close as of yesterday on Wall Street. You can see S&P 500 down almost 3%. But if you look towards the bottom, it was really the Russell 2000, the little guys on Wall Street that saw a big chunk of losses, 4.4%. Now, if we can flip this board over and just have a check on where we stand as we head into the session today, we're not doing a whole lot, and I think that's just because there were such steep losses yesterday that traders probably need to have a little bit of a pause for just a second to consider all that we heard. But the NASDAQ 100 futures down 0.1% or so. The U.S. 10-year yield sticking around 4.5% after the sell-off in treasuries yesterday drove that yield to 4.5% for the first time since May. The dollar holding steady around the highest level since 2022. And then when we look at spot gold, we're seeing a little bit of a recovery. There were pretty significant losses for the metal yesterday. It took that metal to the lowest level in about a month, but a little bit of a recovery today. Now, let's keep talking about the Fed because, of course, I mentioned that they reined in their guidance for 2025. Here's what Jerome Powell had to say.
The committee decided to lower the target range for the federal funds rate by a 0.25 percentage point. Committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. To cut further after this point, I would say it this way. We've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation as well as continued strength in the labor market.
Well, for more now, let's bring in Bloomberg's Katya Dmitrieva. So, Katya, clearly the markets took a very strong reaction to what we heard from Jerome Powell yesterday, and you heard in his comments there around inflation, the economy, the path of interest rates. Why did what we hear surprise markets so much?
Well, this was the clearest indication yet from the Federal Reserve about just how tricky it is to get inflation back to their 2% target. We had seen signs of it with PCE, with jobs market being a bit stronger than expected and holding those gains from earlier this year. But this was the clearest indication, when Powell said that they're looking for more progress on inflation. And there were other signs as well. So reading through what not just Powell said, but also the dot plot, what officials were saying, it's clear that they see those inflationary pressures not just sticking around, but actually moving up next year. So not just 2 cuts instead of 3, which is what they said just a few months ago, what analysts were banking on, but also inflation ending the year in 2025 at about 2.5% instead of 2.1. So you can see that's a very different trajectory. And also only 5 officials said that they were even interested in reducing rates further. And so as you can see, there was a much more hawkish tone and perhaps something a bit more hawkish than markets were even expecting.
Yeah, that does seem to be the case based on the reaction. And something else that came through, policymakers did say that they actually now don't see inflation returning to the 2% target until 2027. They previously saw that in 2026. So to your point, Just a lot of change here. What does this mean for central banks globally? We have a lot of other decisions coming down the line today.
Well, another, more decisions, but also we have the big question of Donald Trump and what he's going to do when he takes office January 20th. You'll note, and very importantly, that the Fed moving up their inflation expectations is actually even before tariffs and potentially the impact on prices, which analysts expect will kind of boost prices further. So it's not looking great for central banks, but it really complicates the picture, right? Because especially here in Asia, we have a lot of central banks that are very sensitive to currency weakness. And so this limits kind of what central banks can do. They can either intervene in the currency markets, or they can kind of just accept this weaker currency going forward. It also complicates the picture when you have tariffs coming in, and that would potentially weigh on trade. So the next couple months will be a big question. As you said, the next couple hours will be a big question. We have the BOJ's Ueda actually speaking later this afternoon. So that'll be interesting as well, because it's the opposite dynamic there in Japan.
Yeah, opposite indeed. Katya, thanks so much for all your insight. That's Bloomberg's Katya Dimitrieva. Well, let's stick on the topic of central banks, because as Katya mentioned, we have a lot coming up in the hours ahead. The Bank of Japan was first up this morning. It has kept its monetary policy settings steady, signaling that it sees little urgency to raise interest rates for now, given ongoing economic uncertainties. Bloomberg's The Asia Trade co-anchor Sherry Ann joins us now from Tokyo. So, Sherry, the BOJ took no action this morning, which was pretty much in line with expectations. But what did we hear of the statement out of the statement that we have received?
I mean, it was pretty in line with expectations, as you say, Christine. But what was really interesting was the fact that we got the first dissent since BOJ Governor Ueda took the helm in April of last year. And this really signifying that 8-1 vote that there is now growing concerns about inflation risks to the upside. Naoki Tamura talking about really seeing that upside risks for inflation rising in the economy. He wanted to raise the rate to 0.5%. That didn't happen. Economists had expected no change. So the rate was left at 0.25% as expected. And they cited, as you said, that uncertainty over the economy. But what is really interesting is that the BOJ cannot be political, so they can't talk about the politics behind the scenes. But the economists that we surveyed here on Bloomberg were also expecting that because Prime Minister Shigeru Ishiba has just proposed that extra stimulus budget, that really the political momentum and sentiment is not there for the BOJ to hike rates at the moment. In fact, an opposition party leader talking about this not being the right environment to hike rates. The BOJ is not political. The BOJ is independent, but that was a key consideration that people were watching.
Yeah, and we're due to hear from Kazuo Ueda in just a couple of hours. What are we expecting him to say? Do you think it's possible we'll see him kind of kick the can down the road for the next potential rate hike?
That could be a very big risk, especially for the Japanese yen, which turned negative against the U.S. dollar as we saw this statement. I mean, we do have the yen at around the 155 level against the U.S. dollar. And more weakness for the yen just means more inflationary risks for the Japanese economy as well. And households have not been happy, feeling poorer and poorer because of these inflationary pressures. We are continuing to see a virtuous wage cycle, something that the BOJ pointed to. The cycle between wages and prices continue to intensify, but they were clear on the fact, reiterating again that the FX developments are more likely to affect prices than in the past. So that pressure, very important. The communication has been criticized by BOJ watchers that really the expectations have not been clear. So if he's too dovish, that could send the yen plunging even more against the U.S. dollar. Could we see that 160 level that we saw back in July? They were forced to hike because then we had politicians even coming out talking about how this yen weakness is not helpful for the economy. So it's a very, very tricky position that Governor Ueda is in. So we'll be watching those comments very closely today.
Indeed. Bloomberg, Sherry Ann, thanks so much for unpacking that all so shortly after we got that BOJ decision. Now, Sherry Ann mentioned the yen there. Let's check in on how markets more broadly are faring in Asia and also consider how the yen is performing. Avril Hong is standing by in our Singapore studio. So, Avril, break things down for us. How are Asia markets trading in the wake of that massive sell-off that we got on Wall Street yesterday?
Yeah, I think really that's the focus, even though we saw that move from the BOJ, that's being reflected in the moves of the Japanese currency. The Japanese stocks, they're still well into negative territory. This is broadly what we're seeing in the rest of the region, right? Following the Wall Street sell-off, a dismal performance that is putting not just stocks but FX traders also on the back foot. We're seeing declines in the Korean won to levels we haven't seen since 2009. The rupee hit a record low. And in terms of stocks, if you look at the region's benchmark, it's at the lowest level since September. All the sectors are down today. The declines are being led by tech. Christine?
Thank you, April. That's April Hong in our Singapore studio for all things happening in Asia. Well, still ahead, we get SEB's outlook for the Fed in 2025 after, of course, we got the central bank trimming those expectations for rate cuts next year. We'll talk more about their market strategy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Christine Burke in Dubai. Well, Asian stocks are sliding today after the Fed trimmed expectations for rate cuts next year. Let's bring in Eugenia Victorino, head of Asia strategy at SEB. She joins us in our Singapore studio. So, Eugenia, great to have you with us today on such an important day where we are unpacking the reaction to the Fed. What do you make of what we heard from Jerome Powell, especially considering that your expectation going into this meeting and for the dot plot was that we would continue to see the Fed project 4 rate cuts in 2025. So the Fed was a lot more hawkish than even you predicted.
Well, definitely, Jerome Powell could not have been more hawkish than anybody could have expected at this point. Considering the totality of the data, we were not expecting that the dot plots would go up so much, because at this point, the dot plots are already reflecting the possible impact of Trump policies. And Trump is not even president yet. We have to think about the timing of these policies. Which are the tariffs that will be put in place before any of the Fed cuts can be put there? But obviously the policymakers are thinking about it, and we are shocked that now they are actually following the market. The problem is when you follow the market pricing, the tendency of the market is to overshoot, and now even the market is pricing in even less than 2 cuts for 2025.
That's right. It's always this little bit of a tug of war, if you will, between the markets and the Fed when it comes to expectations. Talk to us about inflation. We got some pretty strong comments around the concerns around inflation. 15 of 19 policymakers saying yesterday that they are concerned about the upside risks to inflation for 2025. Do you think that concern is warranted in your view?
Well, if you look at the resilience of the U.S. labor market, there is definitely a concern that the inflation will not go down. But no matter what you look at, no matter what economy you look at, it's always the last mile of the inflation, taking it back to the target range. That is always the hardest. Having said that, if you look at the policies that are likely to be put in place, they are inflationary. But at this point, it's not clear whether that will have an impact in 2025. Because if you look at the Trump policies, the trade war in 2016 up until the end of 2019, that did not really have an impact on prices substantially. Well, however, there are other parts of the Trump policy package that are definitely inflationary. But at this point, it's very difficult to see whether those policies will have an impact for the 2025 inflation rather than in 2026.
So much uncertainty. And that brings us to the BOJ, which we just heard from. And uncertainty was a word that they are using a lot as well. What do you expect that we're going to hear from BOJ Governor Kazuo Ueda in the next couple of hours after the central bank took a decision to stand pat, which was pretty much in line with expectations?
Well, the BOJ, the policy announcement is usually not much of a surprise. It is actually the press conference that tends to surprise the market. So Governor Ueda seems to have that preference to to communicate a little bit more than what the policy statement would usually give out. However, looking at the policy statement, considering that they are already acknowledging that there are wage gains and that you have inflation expectations rising, and now you also have the fact that the impact of the FX moves on the inflation is likely to be greater against this backdrop. Overall, my expectation is that the BOJ actually has more room to tighten in 2025. We were already of the view that January would be the start of the hiking for 2025, but considering that the Fed is more hawkish, then there is actually further risk of further hikes from the BOJ than we had earlier expected.
Right, and so as we consider all of that, where do you see the potential for the yen to go from here, especially as we are seeing dollar strength in the wake of the Fed decision? And then let's consider the potential that we get word from the BOJ today that, yes, a rate hike is in the cards for January. Then what?
At this point, dollar-yen is not really dependent on the BOJ. The BOJ can be as hawkish as it can be, but at the end of the day, it is the Fed policy and how the market is pricing in the Fed that would dominate the U.S.-Japan rate differential. So at this point, there's very little that would stop the dollar-yen from going up even towards 160, considering that it's quite likely that the Fed will pause in January and maybe even in March. So at this point, BOJ is really in a tight spot. What they can do, or what Governor Ueda can do, is actually lead the market to expect further hikes after January. But in the near term, we're probably looking at 160.
All right, so 160 in your view. Well, thanks, Eugenia, for sharing all of your insights and unpacking that after the Fed decision and as we await the statement from Ueda later today. That's Eugenia Victorino, head of Asia strategy at SEB. Coming up, Turkey-backed forces are reportedly aiming to capture more territory in northern Syria from Kurdish groups. More on the latest developments in Syria next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Christine Burke in Dubai. Israel's deputy foreign minister says Syria's new leaders are trying to persuade the world they are not radical Islamists, but her government isn't convinced.
We are very aware of what they're saying, but the fact is that we are going to look on their actions, and that's going to dictate how we react to that. These are wolves in clothes of sheep, and we are not fooled by nice talks.
Bloomberg has also learned that Turkey-backed forces are aiming to capture more territory in northern Syria from Kurdish groups. For more on the latest developments happening in Syria, Donna Kreisch, Bloomberg's UAE bureau chief, joins us now. So, Donna, it's good to see you this morning. Talk us through or what we know about Turkey's ambitions in Syria with its forces there.
Good morning. Yes, so we did learn that the Turkey-backed forces, which is the so-called Syrian National Army, want to capture more territory from those controlled by the Kurdish forces with the YPG. Now, this has been Turkey's kind of one of the main goals, right? It is to not allow Kurdish forces to have any kind of semi-autonomy over certain territory in Syria or anywhere around its border. And what we are seeing now is heavy battles in these regions, especially near Kobani, which is where the Kurdish forces are, mainly there. And these Kurdish groups they have been a key ally to the U.S. and they have successfully expelled to some extent ISIS from many areas that they had occupied in Syria several years ago. So now this military push that is backed by Turkey could be a cause of concern for the U.S. We saw there were some reports that the U.S. was concerned about that, and they were asking Turkey not to do anything in that border. But Turkey's main goal is to not allow the Kurdish forces to have any political representation, especially in or, near that border. And they want to create, it seems, a buffer zone. Now, there are questions over if that buffer zone, who will it include, right? Will it include Kurdish? Would it include Turkish forces, rebel groups that have taken over Syria, of course, in recent weeks? And what will the Kurds do, right? Are they going to fight for semi-autonomy once again, or are they going to be or want to be included in the overall Syrian governance now?
Where's HTS in all of this?
Exactly. It hasn't been very clear about where does the Kurd question, right, the Kurdish question fall into this whole Syrian, the new Syria, I would say. But the rebel leader has said that they want an inclusive government for all minorities. So the question of whether the Kurds will have any kind of semi-autonomy in their region seems to be out or off the table, I would say, for now for these rebel groups.
Donna, thanks so much for sharing all that insight with us. Dana Kreisch, Bloomberg's UAE Bureau Chief, thanks for all of that. Now let's take a look at some of the other stories that we are watching this morning. Bloomberg has learned that VW and labor leaders are moving closer to a deal to restructure the automaker's namesake brand without shuttering factories in Germany. Management is willing to keep plants running and reinstate job security agreements until 2030 in return for workers foregoing bonus payments. Now, sources say the details of an agreement could still change and that the talks may still end without a deal. Micron plunged post-market after its second revenue forecast missed projections by about $1 billion due to sluggish demand for smartphones and also for personal computers. The tech major expects sales to be roughly $7.9 billion in the fiscal second quarter. That's worse than analysts estimated. Barclays is set to increase annual bonuses by up to 20% in its investment bank. Sources say staff in the trading unit are expected to see a 5 to 10% rise in their annual awards. Bankers in debt and equity capital markets could see bonuses jump by between 10 to 20%. This is a turnaround from last year when dozens of bankers got no bonuses at all. Well, as we head into the bottom half of the hour, you can see that markets are pretty much all over the place. So coming up, we'll be talking more about all that. And also, Israel's deputy foreign minister says her government won't be fooled by Syria's new leaders as they try to persuade the world they are not radical Islamists. We will hear more from Sharon Haskel next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa, our top stories this morning. Jerome Powell points to inflation as a reason for reining in the number of cuts in 2025, sparking the worst sell-off for the S&P on Fed Day since 2000. The yen weakens as the Bank of Japan keeps rates on hold. The central bank says the economy is set to keep growing, with FX more likely to affect prices. And Israel's deputy foreign minister says Syria's new leaders are trying to persuade the world they are not radical Islamists, but her government is not convinced. Well, it's just gone 8:30 a.m. across the Emirates. I'm Christine Burke in today for Jumana Bersetchi. Well, let's take a look at how markets are shaping up. We did get that pretty nasty sell-off yesterday in the wake of that Federal Reserve rate decision. It wasn't really the decision that drove the moves in markets, but rather the fact that Jerome Powell took a pretty hawkish tone, and policymakers are now forecasting just 2 rate cuts in 2025 versus previous expectations for 4 cuts. So a lot was taken off of the table. Leading into today's session, what we are seeing is that weakness is continuing in the U.S. equity futures markets. And also the U.S. 10-year yield continues to trade around 4.5% after yesterday climbing above that level. For the very first time since May, the Treasury sell-off was one of the worst that we've seen for Fed day reaction in quite a long time. The dollar continues to be steady, and gold is seeing just just a little bit of a recovery. Well, let's talk more about Japan now and Asia markets and take a closer look at what is going on with the yen. Avril Hong is standing by for us with more. Actually, apologize, I went to that too early. Let's talk about the BOE because, yes, the BOJ is in focus and the yen, but it is the BOE today that also happens, and we're going to be talking about this more. This chart here shows you that market expectations have pulled back for BOE rate cuts in 2025. We are expected to see that the BOE will cut just twice in the next year or so. We are going to get a rate decision later today, and we will talk more about that. Now, for real, let's go back to the BOJ and take a closer look at what's happening at the yen in Asia markets and get over to Avril Hong, who's standing by in our Singapore studio. Avril, what are you watching?
Yeah, I mean, looking at the Japanese currency, right, after the BOJ left rates unchanged. This was certainly, as most economists predicted. The problem is the inaction and how that actually played out in the Japanese currency. So we saw it reacting against the dollar. The concern here by traders, if we don't see the governor actually send out clear signals of a January hike, and beyond that, what's going to do beyond that for March, for May, will we see dollar yen at 160? Remember here, it's really a backdrop where the data in the Japan economy, whether you're talking about wages or inflation, they've all been backing the case for the central bank to tighten. But we're seeing the yen just losing ground against all these G10 peers today. It's not just on the back foot given the hawkish Fed cut that played out against greenback, but we're also seeing it losing ground against the pound.
Yeah, interesting. Thanks so much, Avril. That's Avril Hong standing by in Singapore. Well, let's talk more about the pound and also the BOE because traders are looking ahead to the Bank of England's rate decision a bit later today, which follows the Fed's move to rein in the number of cuts it sees in 2025. For more, Bloomberg's MLive FX and rates strategist Ben Ram joins us now. Good morning, Ben. Great to have you on set. Let's talk about the BOE. We've been talking about the Fed. We've been talking about the BOJ, but we get the Bank of England's later. And market expectations have been shifting this week for 2025. What's behind that?
Absolutely. I think that, the reaction in the markets we are seeing is a lot owing to inflation because the autumn budget that Chancellor Rachel Reeves outlined humongous borrowing and spending plans. So that means that inflation vigilantes are kind of thinking that, look, inflation is going to maybe get out of control. If you look at the two-year break-even rate, it's at 320, 325. So if you tack on 100 basis points of restraint above that, you will get a BOE funds rate of 425. And that's what the markets are kind of beginning to cotton on, that they are thinking that, look, 3 rate cuts looks a bit too stiff from here. So maybe 2 rate cuts. And we will see the impact of what happened with the Fed overnight because the Fed was hawkish. I think that repricing has further to go, and gilt yields will kind of nudge higher at the open.
Yeah, and we saw yesterday from the Fed that they conform to market expectations a little bit, albeit now markets have gone a bit further in terms of scaling back their rate expectation or their expectations for rate reductions. Do you think the Fed, or do you think that we'll hear a similar kind of tone today from the BOE? Will they align more with the markets?
Well, I think that the BOE is unlikely to say anything more than what they've said in November because this is mind you, today's event is going to be without a press conference, without a macroeconomic update. So it's going to be a statement-only review. So they are unlikely to move away from the boilerplate that they've been using last month. So which is why what inkling the BOE has in mind we'll get to hear in the start of the new year, not probably today.
So is it gilt yields higher for longer?
Definitely, because if you've got in 2-year break-even rates at 325, you've got to factor that in. And if you look at the 2-year gilt yield, it's at 445 at the moment. And that is kind of sending a very loud message. If you look at the BOE's benchmark rate, it's at 475. So the gap between the BOE rate and the 2-year gilt yield is not very much at all. So that shows the market's pessimism that the BOE will be able to shoehorn in rate cuts as they want to.
All right, Ben, well, thanks so much for all that. We have a lot to watch as we head into Europe as well, and also as we keep an eye on the BOJ. That's Bloomberg's MLive FX and rate strategist Ben Ram. Well, next, President-elect Donald Trump says he opposes a proposed government funding bill threatening a stopgap measure that would keep the government open until mid-March. Let's get more on this now with Bloomberg's Bill Ferries. So, Bill, where does this leave negotiations in the House over this spending bill? Don't we need to see something get through or get over the line by the end of the week?
Yeah, absolutely. There's a deadline looming end of the week when there would start to be a partial government shutdown if there is no agreement. Where do things stand now? It's really kind of a meltdown that is in progress. We know that in the last hour or so, Vice President-elect J.D. Vance met with House Speaker Mike Johnson in his office on Capitol Hill. Vance left that meeting saying that they had had productive talks, but there's still no deal on the cards. So Republicans are really in a bind here in terms of running up against this weekend deadline. It would send parts of the government into a shutdown just before the Christmas holidays. There are, of course, parts of the Republican Party that aren't too worried about that happening. But most Republicans, I think, are not feeling like that would set the right tone heading into Donald Trump's inauguration just a little over 4 weeks away at this point.
So what are the realistic options from here over the next 2 days, I suppose, right? Because it's already Thursday. And what would Trump's preferred scenario here be?
Yeah, there's a couple different things that could happen. I mean, Mike Johnson could go ahead and try to push this bill through. He was always going to rely on Democratic votes to get that passed. That does seem to be one of the least likely solutions now. They could also come up with spending legislation that perhaps keeps the government agencies running at the levels of funding that they were already receiving, but takes out some of the extras that were thrown into this bill. That includes about $100 billion in emergency aid to communities that were hit by hurricanes earlier this year. That's one option. There's other parts of the legislation that could go through. What Donald Trump is saying he really wants, probably more than anything, is for the current Congress to agree to lift the debt ceiling. That debt ceiling is set to expire in the first half of next year. That is a political fight Donald Trump would rather not have early in his term. He wants to have the Democrats, he wants to have Joe Biden take the credit or the blame, depending on how you look at it, for passing that right now. It's not clear whether that can really happen, whether Democrats will allow that kind of legislation to pass.
And where's the House Speaker in all this? Mike Johnson thought that he had a deal. We don't seem to be seeing that now. What's the risk to him as this all plays out in Washington, D.C.?
It's not one of the harder jobs in the world, but it is probably the hardest job in Washington right now. Mike Johnson already had to negotiate with Democrats in the House, including in the White House representatives. He had to negotiate with different factions of his own Republican caucus in the House to get this legislation. And he admitted last night that he was in the middle of texting Elon Musk and Vivek Ramaswamy, the two outside advisors to Trump on government spending, to try to get them to realize the situation he was in and how there was a need to get some kind of spending bill passed. And then when Trump takes office, they could go forward and try to change it. He's negotiating with an increasing number of partners, and his speakership will really be at risk almost no matter what happens in the coming days and coming weeks.
All right, Bill. Well, you heard it there from Bill first. The toughest job in Washington, D.C. right now. Thanks. That's Bloomberg's Bill Ferries again. Thanks so much for all of that. Now, let's get back to the Middle East, because Israel's deputy foreign minister has described Syria's new leaders as wolves in sheep's clothing who are trying to persuade the world they are not radical Islamists. Sharon Haskel told us her government will not be fooled by the rebels' public comments.
We're not fooled by many of the conversations and the interviews that those, rebel groups, who are in fact terrorist groups. Let me remind you, al-Jolani, he was part of ISIS. Al-Jolani was al-Qaeda. And right now, the way that they speak, we are very aware of what they're saying, but the fact is that we are going to look on their actions, and that's going to dictate how we react to that. These are wolves in clothes of sheep, and we are not fooled by nice talks. I think that one of our worst mistakes leading up to the 7th of October is that conversation about peace, about coexistence, about that conversation that Hamas has said that they will not intend, and the Western media who have described Hamas as a legitimate government of the Palestinians, and Israel has paid a horrifying price on the 7th of October. We will not do the same mistake again. We will follow up close on the actions of those different militias groups and the new government of Syria. And the one thing that is in our mind is to make sure that we can protect and defend our borders and our communities.
Mm-hmm. Can you give us an idea of how deep Israeli ground forces are in southern Syria today?
We just a few days ago, and it was already widely reported, Israel has entered the buffer zone. The buffer zone is an area that was meant to stay clear of any armed groups, including armed militias, and unfortunately, those rebel groups have violated the disengagement agreement signed since 1974. Those groups were trying to attack also United Nations positions that were located there. And following up the situation, we've decided to enter the buffer zone to make sure that it stays protected and that those militias groups, those terrorist organizations are not set close to the Israeli border. There was another part up in the north of the Golan Heights where we actually took a part from a topography point of view, a higher point so that they cannot surprise us. And in that respect, these actions are temporary and obviously limited. And the main goal was to defend our country and to defend our people and the communities that some of them live on that border.
Welcome back to Horizons, Middle East and Africa. I'm Christine Burke in Dubai. The Democratic Republic of Congo has filed lawsuits against Apple's subsidiaries in France and Belgium, accusing the company of using, quote, pillaged minerals from the country in its products. The iPhone maker has denied the claims, saying it has committed to sourcing raw materials responsibly. Let's get more with Bloomberg's William Klaus, who covers metals and mining in Africa. So, William, looking at your story here, there are words being thrown around, laundering through international supply chains, deploying deceptive commercial practices. Walk us through the DRC's specific claims against Apple here. What does it think or believe that Apple is doing?
Yeah, so they're quite serious allegations. The Democratic Republic of Congo has submitted 2 criminal complaints against Apple subsidiaries in France and Belgium. Eastern Congo, which is the part of the country we're concerned with here, is very, very rich in tin, tantalum and tungsten, metals which together are known as the 3 Ts and are used in electronics. Now, this region of Congo has been blighted by conflict for about 3 decades, involving dozens and dozens of armed groups of varying size and capability who've been involved in and financed by this illicit mineral trade. Congo also has very bad relations with its neighbor Rwanda and accuses Rwanda of both fueling the violence in eastern Congo and profiting by smuggling Congolese minerals through Rwanda and onto the international market. In short, Congo is saying that Apple has been acquiring these so-called blood minerals and therefore contributing to this long-running cycle of violence.
Yeah, some pretty strong language that we're seeing come out of this. What has Apple said in response to these allegations? And do we have any sense of what the ramifications could be for Apple if this continues to push ahead?
Well, in terms of the ramifications, the lawyers working for Congo have said that this is an opening salvo, and we could see more cases in other countries in a sort of international campaign. But in terms of Apple, they've come out quickly. They've come out strongly to deny it. They say that they observe the highest standards in their sourcing at the best of times, and that following an intensification and escalation in the conflict in eastern Congo earlier this year, they actually notified their suppliers to stop sourcing these 3 key minerals from Rwanda and Congo altogether. Apple says they did this because due to the conflict, it had become impossible to independently audit and do due diligence on the supply chain. Apple also points out that most of the minerals used in its products, like the iPhone, are recycled from old products rather than recently mined material.
That's Bloomberg's William Klaus. Thanks so much for all of that insight and a story that we'll keep tracking closely. Now, for a look at some of the other stories that we are following today, Angola's economy expanded at the fastest pace in almost a decade as oil, agriculture, and mining production jumped. Gross domestic product accelerated 5.5% in the third quarter from a year earlier. It means Angola is poised to beat the International Monetary Fund's prediction that the nation's economy will expand 2.4% this year. Nigerian President Bola Tinubu is banking on an increase in oil revenue to help fund record spending outlined in the 2025 budget. The government plans to spend 47.9 trillion naira and collect 34.8 trillion naira in revenue, leaving a deficit of about 3.9% of GDP to be funded by raising debt in local and international markets. Ghana's Supreme Court has dismissed a case filed against an anti-LGBTQ bill, meaning the proposed legislation is closer to becoming law. The dismissal is the latest blow to the LGBTQ community, which has, in recent years, seen rights curtailed across Africa. The outgoing president now has 7 days to sign, refuse to sign, or refer the bill to the Council of State for advice. And coming up, Kenya is trying to boost its food security by wooing investors with big agricultural projects. We're live in Nairobi with more details next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Christine Burke in Dubai. Kenya is in discussions with Abu Dhabi's Dahra to lease farmland to the agribusiness company aimed at boosting the East African nation's food security. For more, let's go to Bloomberg's David Herbling. David, good morning and thanks for joining us. This is a great story. It shows the bridge between Kenya and the UAE. Really interesting. Why is Kenya focusing on agriculture?
Thank you. So the focus on agriculture is pretty simple. One, that will help check inflation. Food is about 30% of the inflation basket in Kenya. The country also uses about $5 billion every year to import food products. So if you can take that out, then that will also save the country a lot of foreign currency needs. Also, agriculture is about 20% of the nation's GDP and is the biggest employer. So it makes a lot of sense to then woo investors into investing in agriculture.
Yeah, and as they are in talks to lease this farmland, what is the strategy that they are taking to really bring in these private investors into farming and into this farmland?
So Kenya is providing long-term leases to private investors who want to do agriculture, value addition and all that. So they have about 500,000 acres of land available that investors can lease and do all kind of agriculture. So yeah, it's appealing, and in some other areas they have they're setting up dams and irrigation projects where those who are setting up these plants can have available water and just plant their crops all year round and not really dependent on rain-fed agriculture.
And this is really just a deepening of ties between the UAE and Kenya. We know that the UAE has been trying to build its influence in the country. Do we know more about this relationship between the two countries and where this plays into that?
Kenya and the UAE have been deepening ties in the last few years. There's a comprehensive trade agreement that's being worked on that will enable free trade between Kenya and the UAE. There's been ongoing talks for $1.5 billion of financing to Kenya from the UAE. And so we are seeing this, again, agricultural deal to lease the farmland. I think we're seeing more and more Kenya turning to the Middle East. Traditionally, the focus has been on either the US or Europe or China and Russia. And so now we're seeing the middle powers like the UAE also being big players.
All right. Well, thanks, David. Really great reporting there, and we appreciate you coming on the show. That's Bloomberg's David Herbling. Thanks so much for all of that. Now, let's get a markets board up there for you as we head into the second hour of our show. You can see, looking at S&P 500 futures and also the NASDAQ, that we're pretty much little change after those significant losses that we saw across Wall Street yesterday. European stock futures, though, actually seeing quite a bit of weakness as we head into Europe. A lot going on there today to keep your eye on. That's it for the first hour of Horizons, Middle East and Africa. I'm Christine Berg in Dubai. Stay with us for the second hour with Jennifer Sabazaja in Johannesburg. This is Bloomberg.
This is Horizons Middle East and Africa, our top stories this morning. First of all, the Fed cut interest rates as expected, but 25 basis points, definitely. Jerome Powell points to inflation as the reason for reining in the number of cuts in 2025, sparking the worst sell-off for the S&P on Fed Day since 2001. The yen weakens as the Bank of Japan keeps rates on hold. The central bank says the economy is set to keep growing, with FX more likely to affect prices. And Israel's deputy foreign minister says Syria's new leaders are trying to persuade the world they are not radical Islamist, but her government isn't convinced. Good morning. It is just gone 9 a.m. across the Emirates, 7 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. Welcome to the second hour of Horizons Middle East and Africa. And yes, we did get that 25 basis point cut from the Federal Reserve as expected, but potentially not expected was the ugly sell-off that followed. And just a few superlatives to leave you with. The Dow posting its worst losing streak since 1974. S&P, we mentioned this, S&P 500 suffered its biggest loss since 2001 for a Fed decision day. We also saw the NASDAQ closing significantly down. If we take a look at U.S. equity futures right now, potentially looking to stabilize a little bit when they open later today. S&P futures up just about 0.2% there, but then noticeable dipping below that 6,000 point, which we've been following very closely. We're also watching closely the U.S. two-year yield right now at about 4.35%. We're seeing yields backing off a little bit, ever so slightly, but we did see after we got that cautious tone from the Federal Reserve, we saw across the curve rising yields across the curve, and also have the U.S. dollar and the yen up on the board right now. Paying close attention to this because, of course, we did get that BOJ decision earlier today. Right now, we're looking at the yen at about 155.30. And, of course, we're paying close attention to what we do get from Governor Ueda's comments later today, potentially reversing some of the trajectory that we are seeing from the yen. But let's check in on how markets in Asia are faring. Avril Hong is standing by in our Singapore studio with more on that. Avril, how's it going?
Yeah, Jen, I mean, it's not just about the Fed, it's also about the BOJ, as you alluded to. And while it didn't change rates, as you say, the focus is really going to be on Governor Ueda. He's going to need to communicate very clearly to the markets that the January rate hike is really coming. And not just that, beyond that, what we could see for March, for May. It's been really frustrating, you might know, for yen bulls because the data in Japan, whether you're talking about wages or inflation, it backs the case for the BOJ to continue tightening. But this time around, it stood pat as expected by most economists. And part of this was the fear of domestic political backlash. You may recall how in July, August, when it hiked rates, short markets, it did draw a lot of criticism from lawmakers. So we're keeping an eye on dollar yen ahead of Ueda's speech, but taking a look at Japanese stocks as well. It is part of the Asia sell-off where we're seeing declines also in Chinese assets. Whether you're talking about stocks or the currency, it's just adding to the pressure amid concerns about tariffs. So the Chinese yuan has popped above the 730 level against the greenback. Today, the PBOC was quite forceful in support for the currency via the fix, the strongest versus estimates since July. So keep that in mind. But as I say, it's really a day where Asia stocks are down. I wanted to put things into further perspective for you. If you flip the board and take a look at this next chart courtesy of David Ingles, it'll show you that not only is the region's benchmark at the lowest level since September, it's also broken through some of these technical indicators, the 200-day moving average. So looking very bearish and tracking those declines on Wall Street as well. Jen.
Thanks so much, Avril Hong in Singapore. We will check back in with you in just a bit. Let's go back to our top story. The Fed has lowered its benchmark interest rate for a third consecutive time, but cautioned over how quickly it can continue reducing borrowing costs next year.
The committee decided to lower the target range for the federal funds rate by a quarter percentage point. Committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while establishing further progress, enabling further progress on inflation. To cut further after this point, I would say it this way. We've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation as well as continued strength in the labor market.
For more, let's bring in Bloomberg's Katya Dmitrieva, who is joining us now. So, Katya, give us a sense. I mean, we mentioned that the expectation was this 25 basis point cut, but it was really about the outlook that was the key here. But when you take a look at the sell-off that followed, why was there such a surprise from the markets?
Yeah, it's a great question. I mean, officials really making the clearest case yet that they're going to be squarely focused on inflation. And up until this point, we were seeing some of those inflationary pressures building. So we had PCE, that's sort of the Fed's preferred measure of prices. That's been kind of up above 2% since June, essentially. It was heading in the right direction up until mid-year and then just rebounded. And the labor market, we were expecting to finally see some weakness there, whether in wages or payroll gains. But the labor market hasn't let up either. And so that's why we had this almost pivot today from Powell during the press conference. And even if you look across the statement as well as the presser together, you'll see that there were other signs of this more hawkish tone. So, for example, up until 2025, the target is now 2.5%. That's where Fed officials now see inflation. That's significantly above their 2% target. Previously, it was 2.1%. And as well, only 5 officials actually prefer to further cut rates, to further reduce heading into next year. So the picture has pretty much flipped for markets overnight. Another thing that they're probably looking forward to or looking into the future on is Trump. We have President Trump, who's going to be inaugurated January 20th. He said that on the first day he's going to be imposing tariffs. And this is something that Powell said during his press conference is not even something that officials are yet putting into their rate cut expectations. You know, it's in the back of officials' minds, but because the policy hasn't been announced yet, they're not factoring that into monetary policy quite yet. So there's kind of a, markets were generally spooked by that, and we'll probably see that hanging over the markets up until we get some more certainty on tariffs.
Katya, talk about the divergence between what we're seeing in the U.S. We'll also get the BOE later today. We just got the BOJ. What is the picture for central banks globally? Is there a consensus that you can thread through all of them, or are we going to continue to see more divergence in 2025?
I really wish there was a consensus, as a reporter when we're looking at doing these big thematic stories. And unfortunately, it's exactly the opposite right now. So we're seeing this divergence happening globally, not just from the Fed. Well, the Fed really leading the way, but you have the BOE, you have the BOJ, which is going in the complete opposite direction. But what's clear, especially overnight with what markets have shown us, is that the Fed is really throwing other central banks for a loop, especially emerging markets, especially here in Asia, where they're a lot more sensitive. Their currencies are a lot more sensitive. And so there's going to be, from depending on which central bank you're looking at, depending on the economic conditions, inflation has really moved down broadly across the region. But with the Fed keeping rates higher for longer, it really restricts the amount of easing that these central banks can do. And so they're left with basically two choices. They can either let their currency weaken, or they can continue to intervene, as we've seen, for example, the BOJ doing increasingly. And this is something that will be a theme probably continuing into 2025, where initially we had this story even a couple of months ago of the Fed kicking off, you'll remember, with 50 basis point cut, kind of leading the way for the rest of the world central banks to do the same. Now it's expectations are kind of all over the place.
Yeah, you're mentioning EMs. We have a gauge of EM currencies plunging to the lowest level in 4 months after that announcement. So really, again, solidifying that comment about the Fed throwing the rest of the central banks and economies a bit for a loop. Bloomberg's Katya Dimitrieva. Katya, thanks so much for your reporting and for joining us. Now, still ahead, the Bank of Japan keeps its rate unchanged, signaling little urgency to hike. We discuss what this means for Amundi Japan's market strategy. That's coming up next. This is Bloomberg. Welcome back to Horizons, Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, the Bank of Japan held rates as expected. Traders, though, will shift their attention to Governor Kazuo Ueda's remarks to see whether a January hike is on the cards. Joining us is Hiromi Ishihara, the head of equity investment at Amundi Japan. So great to get you on. Thank you so much for joining us. Your expectation was, for what we did get from the BOJ earlier today, to leave rates unchanged. The big question is January, as we just noted. What does this mean for January? Is it solidified that we will see potentially a different trajectory than what is indicated in the current statement?
So I think, the December decision was no surprise. And then I still believe that the BOJ is going to hike 25 bips in January. So I don't think that there's no different trajectory from here to the next meeting. But of course, we need to assess the tone setting by whether the governor, later today, whether he can be delivering dovish or hawkish view. But as we know that all the economic indicators are suggesting that the economy is on track. So it's really that if he's delivering a very dovish tone, it's certainly adding extra pressure on the US dollar and Japanese yen movement.
What's your expectation for that, Hiromi? We mentioned we're seeing some movement right now with the dollar and the yen. Will we continue to see some volatility until the markets get a bit of certainty?
Certainly, I think so. The FRB rate cut itself was no surprise, but the tone by Powell was really surprised. And then also that indicating that structurally the US rate going to be higher for longer. So we're going to expect to see further pressure on the forex side unless BOJ is delivering certain message that we are on the track to the normalization. So I think, it's that today Japanese yen hit 155 against the dollars is certainly the level that government is actually getting a little bit uncomfortable level. So I think it's really need to watch closely, and we should expect the short-term volatility in the currency side depending on the message delivered by central bank.
Should we expect then verbal intervention if it continues to push towards an uncomfortable level for the yen?
Yeah, I think so. It's, at 155, it's not the first trigger, but it's certainly getting higher than that level. It's still, the domestic consumption side is very weak, even though the inflation is sort of 2% level, which is not, out of the control. But the government is actually working on a lot of stimulus packages right now, and we are we're going to have the election coming next summer. So certainly the political interest on the controlling the inflation is getting higher towards next year. So it's certainly that the case.
Hiromi, I found it interesting that with this decision, we did see a board member that actually voted against standing pat. That's the first time it's happened since Ueda took the helm in April of last year. Do you potentially see the BOJ being too cautious, especially if we're starting to get some board members potentially thinking they should take a different stance?
I don't think so. It's certainly the one against vote is something that we have not seen regularly basis, but it just, we are really in the situation that the economic indicators are strong, but it's certainly the domestic consumption is not really strong. And also, U.S. uncertainty and other central banks are going to the late cut cycle. So there are, different variables like we are seeing, which makes also, some discrepancies among the board members. But I don't think that it's something, it's very worrisome for, to assess the BOJ decision going forward.
And Hiromi, just paint the picture on where you stand then for asset allocations. Are you still positive on Japanese equities? Do you go overweight in the U.S.? Where are you at this point?
So I think, the market consensus is now more inclining towards U.S. unilateralism. And then I would be cautious about that. And then I still believe that the Japan equity itself is a great diversifier, for that perspective in terms of asset allocation. The Japan, as I am saying that macro environment is really uptick. And then also the valuation-wise is still attractive, even though the company fundamentals are really strong, which I expect EPS growth next fiscal year 10%. But, still the valuation is close to the historical mean level. So it's not overvalued. The company fundamental is very strong. And Japan is also got the unique story of corporate governance reform. And we know that it's still Japanese corporates having a lot of unoperating asset in their balance sheet. And then this should be released further towards next fiscal year, which is going to be an additional relating catalyst for Japan. So I think it's still positive.
Right. we'll wait to hear from Governor Ueda's press conference later today how that potentially changes for the markets. But we'll leave it here. Hiromi Ishihara, head of equity investment at Amundi Japan, joining us there from Tokyo. Thank you so much for your insights. Now, for a look at some other stories we are following this morning. Bloomberg has learned that Volkswagen and labor leaders are moving closer to a deal to restructure the automaker's namesake brand without shuttering factories in Germany. Management is willing to keep plants running and reinstate job security agreements until 2030 in return for workers foregoing their bonus payments. Sources say the details of an agreement could still change and the talks may still end without a deal. Micron plunged post-market after its second revenue forecast missed projections by about $1 billion due to sluggish demand for smartphones and personal computers. The tech major expects sales to be roughly $7.9 billion in the fiscal second quarter. That's worse than analysts estimated. And Barclays is set to increase annual bonuses by up to 20% in its investment bank. Sources say staff in the trading unit are expected to see a 5 to 10% rise in their annual awards. Bankers in debt and equity capital markets could see bonuses jump by between 10 to 20%. This is a turnaround from last year when dozens of bankers got no bonuses. Now, coming up, Turkey-backed forces are reportedly aiming to capture more territory in northern Syria from Kurdish groups. More on the latest developments in the Middle East and in Syria next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasadja in Johannesburg. Israel's deputy foreign minister says Syria's new leaders are trying to persuade the world they are not radical Islamists, but her government is not convinced.
We are very aware of what they're saying, but the fact is that we are going to look on their actions, and that's going to dictate how we react to that. These are wolves in clothes of sheep. And we are not fooled by nice talks.
Meanwhile, Bloomberg has also learned Turkey-backed forces are aiming to capture more territory in northern Syria from Kurdish groups. For more on the latest developments in Syria, Bloomberg's Paul Wallace is joining us now. So, Paul, what do we know about these recent moves from Turkey-backed forces in Syria? What's the goal here for them?
Hi, Jennifer. Well, these Turkish-backed forces, between them and Ankara, actually have a pretty grand ambition, and that's to move all the way from where they are now, sort of in the northwest of Syria, all the way east to the border of Iraq. And this is part of Turkish President Erdogan's plan to create a buffer zone. Turkey sees the Kurdish forces in Syria as a security threat. This is a very contentious move. The Turkish-backed forces have taken 2 towns so far, starting from around the time that Bashar al-Assad's government was crumbling, and according to our reporting, they very much intend to press on. I say it's contentious because the Kurdish forces that they're going up against are allies of the US. These are groups that have been absolutely crucial to the US's fight against Islamic State in Syria in the past decade or more. In fact, these Kurdish groups have been the ones doing the bulk of the fighting against Islamic State. And you are getting, although the Biden administration has been pretty muted on what these Turkish-backed forces are doing, and Trump has actually praised Erdogan in recent days, although not about this, some US senators are saying they might try and introduce sanctions legislation against Turkey unless it gets these Turkish-backed forces to stop their advance.
And Paul, we just heard Israel's deputy foreign minister calling the new leaders in Syria wolves in clothes of sheep. What's the expectation from what we'll hear from HTS about all of this?
So I think this is going on sort of in the southwest of the country. I think Turkey and Israel are among the world powers that perhaps have the most, the most vested interests in what goes on in Syria. So Israel is very much saying that the world shouldn't believe HTS, the group that took Damascus, has moderated. It's a group that broke away from Al-Qaeda in 2016. However, Israel, and to be fair, many Syrians still doubt that they will treat ethnic and religious minorities in Syria fairly. HTS's leader, Ahmed al-Shara, has been doing a lot of media interviews. He did one with the BBC last night in which he said they have moderated and that HTS poses no threat whatsoever to Israel or any other neighboring state. And that's the message he's trying to get across, to ease sanctions on Syria.
Right. Bloomberg's Paul Wallace. Paul, thanks as always for your reporting. Now, coming up, we dig deeper into the Fed moves. Coming up next, stick with us. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Jerome Powell points to inflation as the reason for reining in the number of cuts in 2025, sparking the worst sell-off for the S&P on Fed Day since 2001. The yen weakens as the Bank of Japan keeps rates on hold. The central bank says the economy is set to keep growing, with FX more likely to affect prices. And the central bank's bonanza continues. The Bank of England is expected to hold today as inflation jumps to an 8-month high. Good morning. It has just gone 9:30 a.m. across the Emirates, 7:30 a.m. here in South Africa. I am Jennifer Zabasaja in Johannesburg. Welcome to Horizons Middle East and Africa. And it is continuing to be a busy central bank week. We will get the BOE later today. We're still awaiting the BOJ press conference from Governor Ueda. But still, markets reacting to what we did get from the Federal Reserve on Wednesday. The expectation was 25 basis point cut. We did get that, but was not expected potentially the ugly sell-off that we did get. So we mentioned the S&P suffering its biggest loss on Fed decision day since 2001. Another superlative that's not great for markets. The Dow posting its worst losing streak since 1974. We also saw the NASDAQ closing down on Wednesday. Right now, if we take at U.S. equity futures, looking like a bit of a mixed picture for when the markets open later today. Significant, though, is that the S&P did dip below that 6,000 print. We'll wait to see how that pans out. And again, it was this cautious tone from Jerome Powell about 2025 reverberating across the markets. We did see Treasury yields across the curve continuing to rise from that after that Federal Reserve statement and that meeting that we did get. Right now, the 2-year at 4.35%. And we're also paying close attention to the dollar. It did gain on the news, but reacting, of course, as well to the BOJ decision that we got earlier today. Right now, we're looking at the yen right now, just about 155.38. We are waiting for BOJ Governor Ueda's comments later today. Potentially, we'll see the yen take a turn. We were just speaking to our guest earlier about that. She expects that we'll continue to see volatility for the yen and the dollar. I also want to bring you this terminal chart. We did, as we mentioned, got that hawkish cut from the Fed. We also got a revised dot plot. The new dot plot, 2 cuts in 2025, 2 cuts in 2026, and 1 cut in 2027. That's sending 10-year yields, as we were mentioning, up nearly 25 basis points just this month, the worst since when the Fed last met in October. And as we can see, more and more reaction that we're getting across the board and across markets to this Federal Reserve decision. And now let's check in, though, on how markets in Asia are faring. It's a busy day over in Asia as well. Avril Hong is standing by in our Singapore studio with more. Avril, give us a picture of what's happening.
Yeah, Jen, we've been talking so much about how Asia stocks have been on the back foot today, right? That slump against the backdrop of a hawkish Federal Reserve. So I thought I'd rake through what we're seeing in Asia currencies because it's proving to be really painful for them as well. If you look at the rupee, record low today on the Korean won, lowest level against the greenback since 2009. Of course, in Korea, there's a bit of a double whammy given the political uncertainty in the country. The Chinese yuan popping above the 731 level against the greenback, and today it kind of forced the PBOC into support via its fix, strongest versus estimates since July. So really, it's forcing these Asian central banks into defense mode. It will be interesting to see how they choose to sort of react to the Fed, whether it's through interest rates or intervention, whether verbal or actual. Of course, it's also something that's been complicating things for the Bank of Japan. And as you just spoke about earlier, we're seeing dollar-yen above the 155.3 level. Jen?
Thanks so much, Ava Hong in Singapore for us. Now, back to our top story. The Fed trimmed expectations for rate cuts next year. Chair Jerome Powell says future easing will require fresh progress on inflation. Let's bring in Andrew Matheny, the economist at Goldman Sachs, joining us now from London. So, Andrew, clearly taking the markets off guard was what we did hear from Jerome Powell. What was your take on really his tone, the hawkish cut and the hawkish tone that we're getting from the Fed?
Yeah, good morning. I think we put more emphasis on the caution that that he was emphasizing. The main hawkish surprise in our view to the decision last night was the shift in the dot plot. So the median for 2 cuts next year in the S&P, but we had been expecting 3. The consensus had been expecting 3. In our view, though, his comments in the press conference, while they were certainly emphasizing caution, were actually a bit dovish overall. He continued to reiterate that inflation was broadly on track to return to target. And he also mentioned on numerous occasions that, in his view, policy still remains restrictive. And so that still leaves a case for continued cuts. In the context of employment that is close to the Fed's estimate of full employment, and inflation that's continuing to come down. So we have stuck to a view that the Fed will cut 3 more times next year in March, June, and September, down to a terminal, 350 to 375 target rate for the Fed funds. We do think, though, that as Chair Powell says, you will need to see either more progress on the inflation front or somewhat weaker news on the employment front in order to get that March cut. Our base case is that you won't get more weakness on the on the labor market, but that you will continue to see progress on inflation.
What does this mean, Andrew, for a number of markets globally and economies globally that are reacting to the dollar strengthening? Could we continue to see more weakness in EMs and other markets?
Look, I think you are seeing this play out in currencies, and you've seen a pretty significant strengthening of the dollar since the election results in early November. A lot of the uncertainty, going into 2025, in our view, will hinge on what new policies the new administration puts into place, in particular with respect to trade tariffs, but to some extent also on the fiscal side. So, one reason that Chair Powell mentioned, that they would take a cautious approach was because of this policy uncertainty. It's unclear the extent to which, the effects of possible trade tariffs from the new Trump administration are baked into, the Fed's revised forecasts. But it is quite possible, we think, that that the Fed will want to wait for more clarity on, what the tariff policy looks like before proceeding, and that will keep, we think the dollar, stronger in the meantime. Will keep a lot of emerging markets on the back foot.
What does that mean then for central banks, Andrew? Many of them were waiting to see what the Fed would do. Are they also in a holding pattern until we get a bit more clarity from this new Trump administration?
I think it depends on the extent to which the Fed policy is weighing on local markets. So clearly, insofar as the dollar's been strengthening, this has been a net hawkish development for a lot of central banks. In South Africa, we saw the Reserve Bank immediately shift to a significantly more hawkish tone in its MPC statement at the end of November, really reflecting global developments. While on the other hand, local developments, in our view, remain pretty benign. Central banks need to weigh, the domestic outlook, their domestic outlooks against what must be a more hawkish global backdrop. But I think it does, at the margin, at least put central banks more in wait and see mode.
Andrew, can you talk a bit more about the benign outlook that you think is happening here in the domestic market in South Africa? Many investors were bullish on the trajectory that we were seeing in 2024. What does it mean for 2025?
Yeah, look, in our view, I think the really key element of the benign outlook from a South African Reserve Bank perspective is inflation, that has fallen to below 3%, so 2.9% on the the last print. Now, obviously, a significant contribution to that has come from non-core factors, fuel inflation, that is running in negative territory, so on and so forth. But underlying inflation is also it's also very weak. You see that in core inflation. That's below 4%. You see that in a lot of other underlying measures. In our view, more than anything, that reflects very weak demand side price pressures, where we have taken quite a different view from the mainstream view and from the SARB's view is on the cyclical position of the economy. We've argued for some time that the potential growth rate has never fallen to as low as the 1 to 1.5% that the SARB and many forecasters assume. And what that means is that the economy, which has performed quite poorly in recent years, in our view, has been operating well below potential, and a large negative output gap has accumulated. So with that, we think the underlying impulse to inflation has been, and will continue to be disinflationary, even in the context of our expectation for growth to pick up more meaningfully next year.
Fascinating insights. Andrew Matheny, economist at Goldman Sachs, joining us there from London. Andrew, great to get you on this morning. Thanks so much. Let's stick in the region. The Democratic Republic of Congo has filed lawsuits against Apple's subsidiaries in France and Belgium, accusing the company of using, quote, pillaged minerals from the country in its products. The iPhone maker has denied the claim, saying it's committed to sourcing new materials, raw materials, responsibly. Let's get more from Bloomberg's William Klaus, who covers metals and mining across Africa, and he's joining us now. So, William, fascinating story. Take us through what is happening here and how this has really emerged.
Yeah, so there's some pretty serious allegations being made by Congo in these criminal complaints. Eastern Congo, the part of the country we're concerned about, is really, really rich in tungsten, tin and tantalum, metals which together are known as the 3 Ts and are widely used in electronics. Now, this region has been blighted by conflict involving dozens and dozens of armed groups for nearly 30 years, armed groups that are both involved in and financed by this illicit trade. Congo accuses its neighbor, Rwanda, of both backing the rebels in eastern Congo and of profiting from minerals smuggled out of Congo through Rwanda and into the international market. And in short, what Congo's lawyers are saying is that Apple has been acquiring these so-called blood minerals and therefore contributing to this long-running cycle of violence.
And we saw something, decades ago, blood diamonds. Many people talked about how that was also playing into the broader story, what was happening across the continent. But, William, can you talk about Apple and its denial? Because they're strongly refuting any of these claims.
They've come out really strongly to deny it. Incidentally, Rwanda denies Congo's allegations too. They've come out to say that at all times they observe the highest standards in their sourcing. But following a recent escalation in the conflict in eastern Congo earlier this year, they notified their suppliers to temporarily stop sourcing any 3T minerals from both Rwanda and Congo. Apple did this, it says, because it became impossible to perform the independent auditing and due diligence of the supply chain in the region. Apple also says that the majority of these minerals used in its products, like the iPhone and the iPad, are recycled from old products rather than being sort of freshly mined material.
Interesting. So it's still a lot to pay attention to here.
Yep, and the lawyers have said there might be more suits in other places.
Wow, okay. Well, a lot to watch out for. Bloomberg's William Klaus, thanks so much. We know you'll stay on top of that. Now for a look at some other stories we are following in the region. Angola's economy expanded at the fastest pace in almost a decade as oil, agriculture, and mining production jumped. Gross domestic product accelerated 5.5% in the third quarter from a year earlier. It means Angola is poised to beat the International Monetary Fund's prediction that the nation's economy will expand 2.4% this year. Nigerian President Bola Tinubu is banking on an increase in oil revenue to help fund record spending outlined in the 2025 budget. The government plans to spend 47.9 trillion naira and collect 34.8 trillion naira in revenue, leaving a deficit of about 3.9% GDP to be funded by raising debt in local and international markets. And Ghana's Supreme Court has dismissed a case filed against an anti-LGBTQ bill, meaning the proposed legislation is closer to becoming law. The dismissal is the latest blow to the LGBTQ community, which has in recent years seen rights curtailed across Africa. The outgoing president now has just 7 days to sign, refuse to sign, or refer the bill to the Council of State for advice. Now, coming up, traders are looking ahead to the Bank of England's rate decision in just a few hours. More on what to expect next. Stick with us. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Traders are looking ahead to the Bank of England's rate decision following the Fed's move to rein in the number of cuts it sees in 2025. For more, let's bring in Bloomberg's MLive FX and rate strategist, Ven Ram, who is joining us now from Dubai. So, Ven, talk to us about how the BOE's messaging can differ from what we did hear from Jerome Powell and potentially what we'll hear from Governor Ueda in Japan later today.
Morning, Jennifer. I don't think we are going to get much by way of messaging from the BOE as such today, because today is a statement-only meeting. So there are no updated macroeconomic projections. There's no press conference. So the messaging that will come out of the BOE will be limited to a very short statement from Andrew Bailey. Now, having said that, the markets are thinking that, look, the BOE is going to be able to put through fewer rate cuts next year than previously imagined. Why is that necessary? Because if you look at two-year inflation break-evens, the rate has shot up like 20-25 basis points in the past month. So the two-year break-even rate is now at 3.2%, 3.2, 3.25 thereabouts. So if inflation is going to be bobbing around those levels, then what is your policy rate going to be? It's going to be at least 1 percentage point higher, which will mean a BOE rate of 4.25, i.e. 2 rate cuts from current levels of 4.75. And that's exactly what the markets are pricing in recently.
So, Ven, does that paint a brighter picture for equities for the UK in 2025? 2024 has been quite the rough year for stocks across the market. What does 2025 hold?
Well, I mean, the UK stock market has risen less than 7% so far this year. That's underperforming not only its regional peers, but also its global peers. Now, I did a fair valuation exercise on the FTSE 100 a couple of months ago. That work is available on the terminal. And that shows that, the FTSE's fair value is 10,479. So it's trading at a 20% discount to its fair value. And, investors are not quite flocking to the UK because of several structural issues. There's an absence of household technology names, and it looks like the index comprises the old world brick and mortar companies. Investors are not getting excited. And unless the structural issues dogging the UK are addressed conclusively, the UK stock market will underperform regardless of whether the BOE cuts rates or not.
Fascinating. That is available on the terminal now, some of Ven's research. FX and rate strategist Ven Ram joining us in Dubai. Ven, thanks as always. Now, coming up, Kenya is trying to boost its food security by wooing investors with big agricultural projects. We're live in Nairobi with the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Kenya is in discussions with Abu Dhabi's Al Dahra to lease farmland to the agribusiness company aimed at boosting the East African nation's food security. For more on this, let's go to Bloomberg's David Herbling, who did write a story for Bloomberg on just this. David, thanks for joining us. Why is Kenya deciding to focus in on agriculture? What's the benefit here for them?
Hi, Jenny. Thanks. So agriculture is the backbone of the Kenyan economy. And the Ruto administration has been looking to boost investments in agriculture to increase production. If there's increased production of food, then that helps check inflation by ensuring there's steady supplies of food. Agriculture is also the biggest employer in the economy, so that will help generate jobs. And also, if there's more local production of food, that helps the country to save on foreign currency requirements. I think the country spends about $4 billion annually importing food.
David, you spoke to the Kenyan official who is potentially looking to make this deal a reality. Talk to us about where they're at right now and seeing this through.
So talks between Kenya and Al Dahra are still ongoing. Potentially, a deal will be reached in the first quarter of 2025. Then Kenya will make available about 200,000 acres of land in an irrigation project located in the coastal part of the country, where this Abu Dhabi company will then carry out its farming activities. So we do hope that a deal may be announced in early 2025.
And David, could we expect more similar deals like this in the agriculture space in Kenya in 2025?
That's right. We do expect more such deals. The country is making available a total of 500,000 acres of land to private investors who can lease this land on long-term terms and then farm on it and either produce food or animal feed or do agro-processing. So we expect to see such more deals targeting big investors because the country has a lot of idle land that isn't being farmed. So the country then decided that why not make this land available to private investors, because the government itself has no fiscal room to carry out the agricultural activities.
Interesting story there. David Herbling in Nairobi for us. David, thanks as always for joining us and for joining us this morning. Now, a quick check at where markets are before we leave you this hour. We did mention Wednesday was a very ugly day for at least U.S. equities. Right now, it's looking like a bit of a mixed picture for futures, but we are watching closely what we will hear from Governor Ueda in Japan later today, and also we will get the BOE decision later today as well. But right now, a bit of a mixed picture for global equities. All right, that is Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe with Tom McKenzie. This is Bloomberg.